Good morning, everybody. Welcome back into Mining Stock Daily in this week's long-form episode. Also syndicated on the new Clear Commodity Network. You can find this podcast and everything else on the network, including a live pricing chart of the commodities complex at clearcommodity.net. We've got a very long episode for you to get you into the weekend. Sounds like a long weekend for everybody up north in Canada, so happy Thanksgiving to everybody up there and north of the border. Hope you have a wonderful day with friends and family. Special thank you to Visa Silver, Arizona Storm Copper, and Minera Alamos for their continued support of the podcast. And like I said, long form episode this week, a very long one. We got a long discussion with Paulo Macro, talking everything on the macro side, really focusing on China and also the election, and really what it kind of contemplates what happens in the bond market mid-2025. Lots to think about from Paulo Macro, as always. And then in our second segment, we welcome back in Doug Ramshaw of Minera Alamos to talk about Mexican mining and what is happening in the first week or two with the new President Sheinbaum and her 100 points and where mining fits into that puzzle and piece of legislation. So very interesting conversation with Doug as well. But it is a long form episode, more than an hour in length, to be quite honest with you. So we're just going to jump right into it. First, here's my conversation with Paulo Macro. Enjoy. Have a wonderful weekend. All right, welcome into our first segment here on Friday's long form episode, and we're going to have a big macro conversation with a returning guest. Somebody actually had the pleasure of joining in with a meal in London last week. I was happy to do that. Great surprise to see him across the table, and now welcoming him back into Mining Stock Daily, Mr. Paulo Macro. Paulo, good morning.
Hey, good morning. How are you, bud?
I'm good. I'm glad it sounds like travels were well and productive for you, as they were for me.
Yeah. I haven't traveled in a little while, and I guess I was just feeling overdue. But I ended up doing a couple of days in beautiful Madeira, Portugal, which is somewhat on the bucket list, but kind of place that, like, unless you have a reason to go, I guess you kind of never get around to it. But some friends decided to maybe get together with other buy-siders, like a kind of for buy-siders, buy-siders type of idea and macro event. There were maybe 20 of us, and we decided to kick it there for a couple of days, and it was incredible. Rare for me to say like I felt like the dumbest guy in the room, but there was some real kind of mental horsepower there. And then of course it's just the most beautiful place. You have like 3 different climates all on the same little rocky island off the coast of Africa, and beautiful vineyards. Madeira wines are what they're known for, and so the perfect balance of talking shop and vino and fine food and pleasant company. And then I figured, as long as I'm going to Europe, might as well zip through London with the LME week going on and see some friends. So it was great to see you on Monday at dinner, and had some just great conversations. It's actually, I feel like I was drinking out of a fire hose for a week, and I'm still having trouble kind of bringing all my thoughts together. Right. But it felt like perfect timing too, with everything going on, the elections and everything going on in commodities, and risk assets are kind of all over the road. The tape feels kind of sloppy, and everyone sort of feels lost. I feel lost. Like I felt great when I got back. I felt like I knew something, and now I feel like a little lost in all of this tape madness. But it was really useful to kind of pull thoughts together. How would you like to kind of
Well, I think you mentioned Madeira before we actually started the conversation. Like, I've heard that airport coming into Madeira can be quite hairy. I've seen some videos. Was it sketchy for you to get in there?
It was fun, man. I actually I between like chapters 2 and 3 of my career, I took a year and decided to get a pilot's license, so I have like kind of a particular affinity for this sort of thing. But you do a final approach. It's almost like Santos Dumont, the local airport in Rio, where the airport is kind of over water on both ends of the runway. So you come in over the water, But as you come in, the island and the mountains are like immediately to your right. So I actually have some pictures of us kind of, coming in over water with land and mountains immediately to the right of us. Like definitely not the kind of place you want to screw around with in the fog. And then it's cute because the airport, it's so pleasant there that they have like a viewing deck for people who are waiting to catch their flights. And so, on the way out, it was beautiful and sunny. We're just all hung over, like waiting on the viewing deck, watching the planes come in and out. And the approach is interesting. You come in and it's like if you go a little long and don't go around, like you end up in the water. It's fun.
Yeah, man. So I guess you're okay with your stomach coming up to your throat once in a while if you enjoy that type of stuff. Very cool. All right, let's jump into markets here and general conversation, because the last 2 weeks, Paulo, there's been a lot going on, and probably if we rewind back to those LME week conversations, this was really on the back of the huge Chinese stimulus announcements, and we saw the commodities just really pick up and go almost everywhere. Even nickel was getting a bid, iron ore was up, aluminum was up. Fast forward a little bit more to a week, and we've seen that Hang Seng index come back down and start hitting some support here, some moving average, but also a lot of those commodities that were moving higher started to see some pullback as well. And this is just kind of on the back of the question, the one that we've been asking here on the podcast, for the last week and a half, actually, and it started off with my conversation with Andy Holm last week, is, all right, the Chinese stimulus was huge news, and we saw market implications with that. But the question remains, is it going to be enough? And where is that stimulus actually going to end up landing when it's all said and done? You wrote a piece in your Substack shortly after that announcement. You titled Chinese Stimulus Implications. And maybe let's go back and talk about what you wrote at the time, and then really what the questions that remain today and what you're seeing on the back of this news.
Sure. A lot to unpack with what China has done. I think at this point, everybody has kind of the key, sort of measures that were laid out. There was sort of the follow-up bazooka that never fired a couple of nights ago that I think left people disappointed. And there's obviously a lot of jaded perspective around Chinese stimulus in the sense that the reopening was such a big bang in the West that when it was China's turn in late 22, myself included, most macro people were sort of looking for the second trade, and it never really happened because consumer confidence was so shattered by the severity and the extent and the length of their rolling lockdowns in their attempts to control COVID that I think we all underestimated just kind of what damage that did to the consumer psyche 2 years ago. And that was also all happening in the teeth of the, Richard Koo style balance sheet recession or what a lot of people have paralleled the Japanese experience of the 90s coming out of their bubble that popped in 1990, where real estate, will be lucky to kind of draw down for 5 to 10 years and eventually, take several decades for them to work out of this. This was a bubble that rivaled or exceeded Japan's real estate bubble, which was something to behold in the late 80s. And you're either going to work out through time or through price or through a combination of both. And we're still 4 years into the process of unwinding this enormous bubble in real estate and land in China. And they've tried to fire some policies at this issue, and the primary issue remains what Michael Pettis describes as the imbalance, the fundamental imbalance in the economy, where in an attempt over the last few years to offset the Chinese real estate collapse, they boosted manufacturing capacity for export in a big way. And they've managed to sort of stabilize GDP with that. But at the same time, the side effect of that, as you've seen, is 75 billion plus type of net export trade imbalances each month, and a real doubling down and moving up through the value chain where, they went from making T-shirts for the rest of the world to making solar panels and automobiles. And they're doing so competitively. And this is, I guess, the way capitalism, in air quotes, works in China, is at least there they'll give you, incentives in the EV space, and 200 companies will show up, and then they'll all fight at basically zero margin, and a BYD and 3 other players will survive. And it's true survival of the fittest, which is great. But then you've overinvested massively in capacity in that space in the meantime, in the prior years, while capitalism was working. And now you need a place to sell this stuff because the Chinese consumer doesn't consume anywhere near the domestic capacity manufacturing base. So some countries wave it in. Others are going through what we see with VW in Germany. That I think that announcement that they were shutting down plants in Germany is an eye opener for people, because China's basically coming for everything. I've mentioned that I went to Brazil in August, and I hadn't been in a couple of years, and I was struck by how maybe 30% of the new vehicles that you see on the road, and people drive cars forever in Brazil, right? Like, the used car market is massive. And there's traffic everywhere. But in Sao Paulo, I'd say like 20 or 30% of all the new vehicles that you see on the road are now Chinese, and I didn't see a single one 2 years ago. It's just literally mushroomed out of nowhere. And the irony of that is Brazil actually has a domestic auto manufacturing industry. It's woefully inefficient. It's unionized. It's everything that you don't pray for as a consumer. Cars are expensive. But it's also protected with triple-digit tariffs, and the Chinese are actually still the cheapest and highest quality option, despite paying triple-digit tariffs on the imports. They may even be selling these at a modest loss and just dumping them. Remains to be seen. But the fact that they have a $10,000 to $15,000 vehicle plus a triple-digit tariff, and it's still competitive with the locally made Fiat or Ford, just shows you that at some point, the way China will eventually get around this, and this is sort of where Trump goes, is they'll just buy these plants off of Ford, which has been trying to get out of Brazil for a few years, and produce them domestically. And that addresses kind of union and other concerns, and then you'll own the market. So in this context, sorry, that's a long aside, but you've replaced the GDP and the economic growth that was driven by real estate with manufacturing for export, but now you've saturated that. And so if that was a bridge rather than the end game for Chinese economic policy, where do you go from here? And I think that this bazooka that they announced two weeks ago, a lot of people are still missing the point that it's not necessarily the size of what was announced. And this is also always the danger of how policymakers signal things, because they keep mentioning numbers, and really they should just do the Draghi open-ended, like, listen, we're going to do this, and like, if it takes 500 billion, great. If it takes $1 trillion, great. If it takes 10 trillion, okay. Because the market will do a lot of the heavy lifting for you. When Draghi said we're going to save the euro whatever it takes back in 2012, he ended up having to do exactly zero, because the market got the message and did the work for him. And I think that we have another meeting from the PBOC, I think this Saturday. The more that they focus less on the specific numbers and just keep it open-ended, I think the better it will be for them, for the market to kind of embrace whatever it is they're trying to do. And in this case, beyond the usual reserve cuts, interest rate cuts, mortgage minimums, dropping, and trying to stabilize housing prices, to me, there are two fundamental issues. One, you have to address the fact that you're in a debt deflationary trap on the real estate side, and that eventually is going to create a crisis among the lending base in China, because the loans are real, but the asset prices are falling in nominal terms. As are the non-existent cash flows around those assets, right? And secondly, you have the issue of a consumer that underperforms in like the Chinese consumer is the weak link.
Yeah. Given everything that they did, you called it the bazooka, and it touched so many different aspects of the Chinese economy, from housing and even stocks, which was a really interesting new approach in trying to keep their stock market alive and well. In fact, you had written about institutional investors can use assets to obtain liquidity from the PBOC to buy stocks initially up to 500 billion won, which is absolutely fascinating. I guess my follow-up question is, obviously there's implications for the Chinese economy, and you mentioned the Chinese consumer being a weak link. I mean, there absolutely appears to be tapped out and really struggling. But how much of this big bazooka-like move here, Paulo, was an attempt to keep the global economy propped up on the back of Chinese export demand? I mean, it seems like there was a lot going on that if, they needed to save face here, because if the Chinese economy was to show its true colors and show complete weakness, and I remember talking to our friend Shrub about, kind of that breaking point on the Hang Seng, but how much of this really was in a recognition that they need to keep the global economy popped up on the back of their own local economies?
Yeah, I mean, to the latter point, I think it's China first, right? Like we're living in a much more kind of multipolar and parochial sort of policy-making mindset. But to the first question, I think that they recognize that this debt deflationary trap, the Richard Koo balance sheet recession driven by deflating real estate, is their sort of key problem to address. But the other side of that coin is the fact that consumption is very low as a percentage of their GDP, and they've always filled that hole with manufacturing for export, and net exports, punch way above their weight, and the consumer punches way below their weight, which is the Michael Pettis view. So how do you reorient the economy away from export and towards internal consumption while addressing the detonation of the real estate industry and that asset class that became such a big bubble over the last 15 years? And I think that they've found a pretty clever answer. This is going to take a long time, to be clear. I mean, Japan had to kind of slog it out for 30 years. I don't think for China it'll take anywhere near that long. But point number one is you need real estate prices to stop falling. And typically you would do that via some form of inflation, and the release valve or the mechanism there would be the currency, right? So the classic kind of Kyle Bass imminent devaluation end of the world view is the only way that they can get out of this trap. But there seems to be another way, and it's a pretty pragmatic one. One, you need to, it's not so much animal spirits as you need to address certain issues around consumer sentiment in the economy. And, stocks have never really mattered to the PBOC, which is why this package from 2 weeks ago was so fascinating, because it's so much of it seemed geared towards the equity market. Like here, equities are everything, right? Like we've financialized the U.S. economy to such a degree that, Nancy Pelosi cares about stocks. Like it's become a meme that like it's stocks first, the bond market second, and the dollar last, right? Because of our exceptionalism and, the U.S. privilege. In China, the order is inverted, where it's the FX first, the bond market second, and then the equities dead last, because less than 10% of the population owns stocks anyway. You have some billionaires, but then you actually have like an interesting segment of the population that does own a lot of stock. And their consumer sentiment is in the dumps because the market has been going down for several years. And there was this fascinating chart from McKinsey that I circulated yesterday that my friend Louis Vincent Gav from GavCal flagged to me, where it shows consumer sentiment by age group or generation and by location. So you have first-tier city, second-tier city, third-tier city, fourth, and then the rural. And then you have Gen Z, millennials, Gen X, boomers. And sentiment is generally okay except for two groups. The rural population, kind of the middle lower income, so the very poor in the countryside, they don't really matter from a consumption perspective. And frankly, you can kind of address them by instituting a social safety net, which they did for the first time. And that was crossing a Rubicon, because Xi has always believed that against giving handouts to the poor, you don't earn unless you work. He was raised in the countryside after growing up, I believe, middle class in the city, was sent to the countryside. So he lived a hard life, and he believes in hard work. So for him to change his mind is kind of a big deal. But it's also, you're opening a door, right? It's like the institution of the U.S. income tax. You say, oh, it's just for a few people who are very, very poor, or in the case of the income tax, who are extremely rich. It's only a dozen people who will fall into this. And now you've opened the door, and within a few years, millions are paying that tax, or millions are receiving this beneficence. And so opening the door is the statement here. It's not the amount of money. It's so small. It's just a small percentage of the population. Completely misses the point. Like, once you've done it once, you can do more, right? So there's an element of the Draghi thing in that. But the bigger issue around equity specifically is that the other poor consumer sentiment segment are the millennials based in first and second tier cities. They are like a black hole for sentiment. And actually, interestingly enough, not a lot of people saw this, but about a month ago, there was a Japanese 10-year-old boy who was stabbed to death on the street by a stranger in, I believe it was in Shenzhen. And if my memory serves, the stabber was a local millennial. And I think that was a catalyst in the same way that the protests at the end of COVID, that we started to see like a few videos of guys gathering in the streets in China on Twitter. And then a week later, it seemed like it all went away and they reopened, and they had never even had COVID. It was like a total 180 degree, right? So they're solving for social cohesion, as we always know they do. But when the moment people started to hit the streets in small groups, COVID was over. Like Xi had this paranoia about COVID, didn't matter. It was over, total 180, reopened the next day. And it was almost like they tried to memory hold the entire prior 3 years. It's like, it's not even like we had COVID. It's like, we've never had COVID. Like, get out and spend and live your life. I think that this stabbing of the foreign boy got them to wake up and realize that, like, the social cohesion of people in the big cities, with the youth unemployment rate being what it is, and the lie flat revolution of the youth who just don't seem to want to work, right? Because what's the point? They needed to address this. And ironically enough, outside of the billionaires, the segment that is most heavily allocated to equities and got burned the most 10 years ago after the bubble in equities imploded, there was like a big run in 2015-16, are the millennials in tier 1 and tier 2 cities. So this stimulus from 2 weeks ago actually addresses the two darkest quadrants of the consumer sentiment mosaic in China. It tries to address the lie flats, and it tries to address the poor in the rural areas. And then, but like, that's what's getting all the attention. The part that I find really interesting is, how do you still deal with real estate, right? You have a lot of people whose apartments have deposits on them, but are still incomplete because the developers went bust over the last few years. So you need to address completion and at least unwind these big, massive behemoths and then kind of shut them down. And you also need to free up disposable income for consumption and start to get people to feel like they don't just need to save, they can spend, right? And reorient the economy in the Michael Pettis way. So what if you were to take the fact that you've got the best performing bond market in the world, and long dated Chinese government bonds are 2%, and they're the envy of the West in terms of cost of interest, and you were to use the federal balance sheet by the trillion to place bonds at 2% and lend at 100% LTV to state and local governments that are all broke and insolvent and whose budgets are upside down, and tell them specifically, go out and bid the developers that are insolvent in your region and all of their empty apartments, buy those at cost, finish them, and convert them to social housing with rent controls. So the lower middle consumer that works his butt off in some factory in a second or third or fourth tier city now has a cheap place to live. And in a way, you're giving their real disposable income a bump, right? Because now they actually have some money to spend, and they're not just paying rent and saving the rest. And you're addressing housing prices at the same time by drawing a line in the sand around the price without reinvigorating the bubble, because the entities that you're buying these apartments from are insolvent and basically defunct. And the federal government will backstop the whole thing. They announced this like 5 months ago with a 60% LTV. And I loved the idea immediately, because I saw that this is how you address declining real estate prices and freeing up disposable income for a consumer through cheap rent at the same time. It's sort of brilliant. It lands like right in the spot. But the big part of the package from 2 weeks ago is that those loans will now be 100% LTV. So basically, the state and local governments are so broke that 60% LTV wasn't enough. So rather than unwinding the program and stepping back, the government said, no, we're going all in. You can borrow 100% of the money required at 2% interest, and just go and do it. And I think now they're going to do it, and the numbers are going to be massive. Again, it won't be overnight. This stuff will take a few years, but I feel like we're going to look up in a year or two and realize like this program is cranking, and it's having an impact at the margin in gradually reorienting the economy away from the direction it was going in, which is Japanification and a weak consumer, all with kind of poor demographics in the background. This has implications, not least of which, and this kind of gets back to the reopening trade that failed. Mm-hmm. I had thought 2 years ago that the CapEx commodities like copper would do well in relation to oil and the OpEx commodities because of the completion factor. And you know, you don't need as much cement to do the completions, but you certainly need copper, glass, sidings, etc., aluminum. And I get the sense that this is kind of a second mouse gets the cheese trade going on here, where we have sort of like a pause in balances tightening for copper globally in 2024. We were supposed to be in surplus by almost 500,000 tons, and then Panama happened and a couple of other things back in late 23. So balances are I think on my latest numbers in small deficit at this point. But we did see consumption get hit in China in the first half of this year, and we built counter seasonally in terms of global exchange inventories throughout the summer when normally we draw. So typically the construction season, because of the winter cold, you build global copper stocks in kind of the December to March timeframe, and then you draw them down for 9 months. And we were building through the middle of the year because Chinese growth basically stopped in the middle of the year. But we're kind of starting to draw down now, and at the same time, you had a squeeze on COMEX that ripped the copper price to $5. There's plenty of copper; it was just in the wrong place. So cathode had to be remade. You had to kind of pivot concentrates from LATAM to the U.S. Rather than Asia. Supply chains adjusted. You had a bit of a squeeze there in the second quarter, and then all the copper arrived, and just in time for the U.S. to kind of hit a soft patch. So copper kind of came all the way back down towards like the lower fours. But now we're drawing again, and now China's economic activity is starting to crank up. And I think that you're going to see at long last, famous last words, a commodity like copper finally have its proper day in the sun. Like we flushed a marginal new all-time high above 5. The market rejected it. Channels cleared. Anybody who was a recycler or a scrapper in Asia cleared their channels because 5 is a fantastic price. You have to sell whatever inventory you have on hand, especially if you're indebted, right? So you're going to go get that money. But now inventories are leaner than they appear. Exchange inventories are there, but the stuff in the channels, I think, is a lot thinner than people are thinking about. And I just get the sense that if China, really wants this, that there's enough here for copper to actually finally break through 5 on a sustainable basis and get us into that kind of, reset new range for the next decade of sort of 4.5 on the bottom and like 6.5, 7 on the top.
Sure.
And I think that's what kind of catalyzes what you and I spoke about, I believe, last time, where phase 2 of the metals bull market becomes one of targeted M&A. Because there's no middle and all the Phelps and Falcon bridges are gone from the last super cycle, you're going to start to see that kind of 10 to 15 global tier 1 advanced exploration asset base start to get picked up in a targeted way by the majors who can't seem to buy each other either, right, based on BHP for Anglo's experience. Yeah. And so like that's kind of how I think about the timing here. It is a 2025-ish story. It could start, it could be working now. But I think the story for the next sort of 18 months is that copper kind of retakes 5. And it doesn't necessarily have to go to 8 or 10, but just re-racking to a new range for a couple of years while China makes this completion transition And remembering also that consumption means, if you put people in rent-controlled apartments, they're probably going to buy a fridge. They're probably going to own an air conditioner. The volumes involved with this stuff are enormous. You start running numbers on like installed capacity, like how much copper is actually in the installed base in India and China, and there's still just so much more room to run. It's not even an electrification story. I feel like that narrative is very tired, the whole EV thing. For me, it's just more simple stuff. Just start counting fridges and air conditioners.
It's emerging market. It's an emerging market story.
That's it.
Yeah,
that's all it is.
That's actually fascinating and I'm glad you broke that down, because through that process and what you were explaining, Paulo, is like if you can see copper starting off to be a 2025 story, that's a meaningful story. On the back of Chinese consumption, obviously they have to get through this real estate issue first, and if they can get people into rent-controlled apartments that are now currently sitting empty, that's got to play through first, right? In order to make this next move into lifting those Chinese individuals as higher up in the consumer spending, right? But first you have to tackle this real estate issue. That's issue
right.
One, right? Yeah.
And these problems are enormous. I don't mean to make it sound simple. Like for me, it's a base case that it's just a slog for them to get through this, and they're going to chew through this problem over time. But I find it very interesting that that's not actually what the sentiment seems to be around all this. There is an intense skepticism, and rightfully so, based on the experience of Chinese policy over the last 4 or 5 years since COVID, that this is not going to be enough, and the numbers being thrown around aren't enough. And when you do the numbers based on what's been announced, it's not enough. But in narrative space, I see a departure in a new direction, and I think ultimately the numbers aren't what matter, because again, it's about a door opening, and the numbers can always get bigger as long as they don't change their minds. And I guess the question is, like, will they change their minds? Like, I don't think so. They've laid down a new path. These are the policies, and if the numbers aren't enough, they're just going to do more.
Right.
I mean, what's the alternative? They go back to doing what they were doing for the last 4 years, and violence picks up and social cohesion starts to fall apart. Like, that is not an option for them, so they'll just do more.
Yeah. Let's transition the conversation to policy here in the West. I mean, there's a number of different directions, and we got a couple of minutes yet here, Paulo, but I do want to ask you about this rate cutting cycle by the Federal Reserve. Genuine thoughts on that, but also the reaction since that move happened. We've seen inflationary concerns rise back up. The bond market has been expressing that. The Drunken Miller came out and basically said he's not short the bond market enough, which was quite interesting. And we got an election coming up in less than a month's time. Thank God that's going to be over with here. Each day we're getting closer and closer to this being over. But, it did have implications, Paulo. So kind of sit back in that chair and express to us what you're watching on the back of that rate cut. And then also, what is the bond market telling you here?
Yeah, I'm sympathetic to your kind of, God, like, it'll be so nice to have this over with in the month. And, my number one kind of
it won't be
quiet
over.
whisk it won't be over. So I heard while I was in Madeira, somebody threw out there that, and I don't know if this is true or not, but it sounds true, so I'll run with it, that back in 2020, Trump was ahead during the vote count in the evening until the mail-in ballots started to show up, and some of the late count stuff came in some of the closer districts. And Giuliani and his people said, Trump, you should stand up now and declare victory. You know what I mean? And just call it. And Trump, for whatever reason, didn't do that. And I don't like to wade into politics because I'm Mercutio, like a plague on both their houses. Like, I just can't stand this anymore. Mm-hmm. But it was interesting that Trump didn't do that. And then Biden won. And Jan 6 happened. And I have to think that Trump is looking back on that now and thinking to himself, I made a mistake. Like, I should have just stood up and taken the W and said, no, I won. If it's close, I don't think he's going to hold back. I think he does stand up and say like before the votes are done, like I won. But Kamala knows this. So what if both of them stand up at 2 a.m. and say I won? Like I just don't think it's going to be over. It's not going to be easy. You know, I live in the tails. I love this kind of stuff because like, it's like my buddy Shrub likes to say, once you realize it's all nonsense, it all starts to make sense. So I called him up yesterday because I needed a little therapy with everything going on in commodities, and he's like, I know it doesn't, like, none of it makes sense, and I'm like, yeah, but even the nonsense doesn't make sense anymore, and he couldn't stop laughing. Like you just try to think of like the craziest outcome possible and make it a base case, and you'll generally be okay. Anyway, come full circle on the bond market question that you asked for. Yeah, I find it interesting that in a weird way, the bonds have kind of become a little bit invisible here. Like people are nervous about it. I know some guys who are really short duration as kind of like a non-consensus trade. And I know Druck called a lot of attention to this, but I just get the feeling that there's a big complacency around the long end. I'm just not sure whether like the bonds really go for it now. It's almost too easy in the sense that like red sweep, bond market implodes, right? Because it'll be tax cuts as far as the eye can see in 2016 all over again. Blue sweep, well, you know, raise taxes on the rich, the deficit still blows out because the money will flee, right? And interest costs will rise, and so it's almost like a lose-lose for the bond market. But everybody knows that, and it seems like a visible argument. So like we're leaking lower in the bonds, and you know, guys like Druck are freaking out, but they also tend to get visible like he did with his steepener last year. And I think ultimately he's going to be right, but his steepener lost him a lot of money in 2023 because the market was already kind of there, and it was a pretty visible argument that was shared by a lot of people. It wasn't the wrong argument. The guy's one of my heroes, and he's the greatest of all time. So like, this is not impugning him in any way. It's just saying that like, the bonds are very difficult for me right here because it's almost too obvious what's coming in terms of the fiscal. I mean, the CBO just came out yesterday saying that the deficit was 1.8 trillion, 1.7 trillion.
$1.8 trillion.
I mean, it's insane, right? Like 1.8 trillion with nominal GDP running at 6. Like what happens if it runs at 2, you know,
right,
or 0?
Right.
There's just, the math will never work. And we're never going to pay this debt back. But I struggle with positioning a little bit here. Everybody in the RIA high net worth world bought bonds at the beginning of this year, late last year. And they've been sitting there kind of flattish on them. And they haven't really made much money. I can see ways that they lose a lot of money in the next 18 months with bonds skidding out of control. Mm-hmm. But I don't know if it's right here. I don't think the bonds need to rip to new low yields. There's also the issue that I can see a world like skating to where the puck will be in 9 months. I tend to think that oil will do better than gold, just based purely on starting conditions and positioning around the market. In the same way that sitting here 9 months ago, 10 months ago, it seemed pretty clear to me that, you know, copper would do better than uranium looking out 6 to 9 months. Right, like there was a lot of love in one and totally invisible in the other. Mm-hmm. Thinking about what the world looks like in mid-25, because that's the other hard thing. It's not just like who wins the election. Like, what the hell does the U.S. and the world look like in 6 to 9 months? You know what I mean? Like, what have they done? And it's hard. It's almost like kind of trying to see around the other side of the event horizon of some black hole. But I think that we live in a world where there's a clear impetus for growth in the rest of the world that gets derailed by a stronger dollar, but politicians here all seem to agree that a weaker dollar is best. And so I kind of discount the derailing of the rest of the world risk at this point. And so there's enough moving in that direction that if capital were to follow the growth, right? And people, the Saudis and the Chinese proverbially take their ball and go home, right? At the margin, I'm not saying they dump the treasuries, but they just stop showing up the way they have in the past at auctions. You start to see tails that are a little bit bigger than before. We're starting to see that. But then the money follows the growth because Chinese stocks are the place to be. You know, Saudi local infrastructure is the place to be. And as the capital arrow points in that direction, it naturally comes out of the two largest parking spots for big money in the world. And those are TerraCap, Mag 7, large cap U.S. equities, and the U.S. bond market. There are really only those two places in town that have the kind of size and depth and liquidity that big money, whether it's foreign central banks or family offices or sovereigns or what have you, can park in. And just the absence or the decline in their marginal bid and their appetite and preference, and Japan plays into this as well, means that you see kind of a leak lower rather than a crash maybe in the dollar, but the dollar will go down with bonds, which is different because normally when the bonds sell off and the yields rise on the long end, you see the dollar rally, right? You see general bid for the dollar because they're the two opposites of the same coin. But you'll also see equities kind of steadily unwind in Mag 7. The question then is, do the indices hold in like the S&P because you get a rotation into the S&P 493 that offsets the deflation or the kind of the air coming out of the balloon in Mag 7? It's not clear to me that we have a collapse, but just a leak lower given the financialization of the U.S. market and the U.S. economy and how the stock market is now the economy. And if the stock market were to go down 30%, the economy would feel it because CEOs would start firing as opposed to just not hiring. And, we're in that kind of stasis in the employment market right now. And so I could see a world where we leak lower after the election. And it has little to do with policy and more just to do with the fact that the arrow for big money is pointing outwardly from the U.S. And as the U.S. dollar kind of bleeds lower through 100 on the Dixie, and this isn't a pro-Europe thing either, because I know the euro is like the biggest component in the Dixie, but I'm not gagging to invest in Europe given the scleroticism of energy policy and the hollowing out of the manufacturing base that's underway there now. But Europe aside, like the arrow is pointing outward, LATAM, emerging Asia. And as the dollar kind of declines in that in itself is a stimulus for those areas of the world. That kind of becomes a virtuous circle. Like the more that the dollar comes off of their neck, the more that their growth loosens up and kind of shakes off the shackles of the last few years, the more the money follows. And, if you don't invest, you don't grow. But if you do invest, you do grow. And so the whole thing kind of starts to feed on itself. And before we know it, the Dixie is now down towards 90 in, say, 9 months. And these economies are ripping and finally feeling it. Consumer confidence is back. And we're all sitting here thinking, shit, like, the U.S. used to be the only game in town. And like Mag 7 and Microsoft and Google and, NVIDIA, the classic casino, were the big 2022 or 23, 24 places to be. And now I'm in exactly the wrong spot. Yeah. That's kind of how I think about mid next year. Mm-hmm. I just don't know if it results in any sort of crash in U.S. equities here. I don't think so. And that's why I keep coming back to this kind of notion of great rotation of growth to value, large cap to small cap, U.S. to rest of the world EM, defensives to cyclicals. Like, who can deny that Mag 7 and utilities year to date haven't been like the ultimate parking spot for defensive, and that cyclicals, despite their fits and starts and some crowding in spots over the course of the year, aren't maybe due. So this is kind of how I think about next year and fitting commodities into that. The quick comment I would say on oil that you asked me about at the top, I'm still at a loss. I understand that the focus of the narrative on OPEC and non-OPEC, OPEC spare plus non-OPEC expected growth on the production side has led the speculative kind of non-commercial or managed money element in oil to think that the downside to their short is limited, right? Because if we go to 90 or 100, it'll never stay there because the Saudis want to bring production back on, et cetera. So, I get that there's an element of limited downside for my position, so let me size it up kind of situation. Mm-hmm. But I really think that this market is playing with fire because outside the obvious event risk, right, of Israel, Iran, the situation around kind of the technical finally seems to be working, and it's happening at a time when over the last sort of 5 weeks, there's been no shortage of people in my life telling me that they are out of energy completely or shorted. And that this, it always comes back to weak cracks. Clearly, there must be a demand issue. Refining margins and weak end product demand, and the balances for 25 are simply impossible. Like we're going to be in surplus, and I discount both in a big way. You can only fight the tape so much, like mentally, but like both arguments to me are now absurd because it's very clear that there's not a clear demand issue in the West for products. That right. The weakness that we've seen in cracks was actually supply driven. Dangote in Nigeria coming online, along with several refiners in Kuwait and the Far East. We've seen this capacity coming for 2 or 3 years. Like there's nothing new here, but they did come on. So remembering also these refineries, they make money at $10 cracks or less. They're new. They're not the refineries that we have here. We're talking about shutting down and driving Chevron out of California that were built in the 40s. Like this stuff is brand new. So it's funny because when you talk to guys in the oils, like they're all short European refining stocks. So like they're telling you it's a supply capacity issue, not a demand issue. It's always both, obviously. The clearing price is a function of both. But like we've had a burst and surge in capacity for refining, and that's sitting on cracks. But guess what, guys? You can have $15 cracks with oil at 100. It just means that the product barrel is selling for $115 instead of oil at 70 and $15 cracks with the product barrel at 85. Like there is a world where guys make money with oil at 100, assuming they can sell the distillate barrel at 115 equivalent. You know what I mean? Mm-hmm. The issue is what is going on with supply demand for the barrel upstream, and all roads kind of lead to tightness for me. And I love the fact that the consensus has been for the last few months that we're taking the price deck down because we've got a mark to market on an oil price that's come in purely based on a massive flush in positioning. I've seen no physical sort of sale overwhelming the market the way I saw with the SPR in 22, the Russia dump in late 22, early 23 when they dumped 40 million euros and another 40 million barrels equivalent of diesel. I've seen no discharge the way we saw with Iran after Hamas in Q4 last year. The only other low that I remember was March, June of 23, and that wasn't a physical dump. It was actually Credit Suisse blowing up and pulling their lines to all the traders. So you saw a flush in the market in kind of March, April of last year that took 2 months to work out while guys kind of got set up with other banks and other merchants. But outside that, like there's no physical dump. This is purely a financial paper dump. And that the narrative is in classic fashion. It's like the market makes the news, not the other way around. So the narrative is following the paper flush, and guys are saying, well, the price is down, so balances must be screwed for 25. And look at cracks, bro. Like clearly there's a demand issue. I was at a dinner a month ago in New York, put on by Sell Side. It was one of these kind of macro dinners. All the major pods were there. And the first guy got up. And his number one idea, and remember, this was actually on the day of the Fed, so it's like not even a month ago, and it was amazing. The number one idea, short oil. The number two idea, short oil. It got to me, and I was like, guys, no offense, but like you're getting me hot and bothered here because you're telling me you've got guys in Asia, and they're telling you that China's screwed. This is what's in the market. Imagine if this changes. And then at the same time, look at the positioning. Like we are in the hole here and net short across the complex. The only other time in my career, going back to 2000, that I've seen oil net short among speculators was in the aftermath of Lehman, briefly for 2 months. And we don't have ICE Brent data going back that far, but the WTI contract was net short by specs. I'd never seen it before. I didn't think we would ever see it again. I was wrong. But what was fascinating about that was that the curve was deeply in contango, and the issue really was because of Lehman blowing up, funding wasn't available for anything, anywhere, at any price for a couple of months. And so that meant that Exxon would do a cash and carry trade riding the steepness of the contango. And you had like over a dozen VLCCs parked off of Houston. It was amazing. There were even articles on Bloomberg about it, where guys were taking delivery of the front month, putting it on the boat, 2 million barrels, and then locking in the price 2 months later and collecting, 15, 20% yield outright, like almost a triple digit IRR in some cases, assuming you had the storage, right? But the storage was available because the boats weren't moving as fast anymore because China was also getting nailed, right? And the whole world was in the depression. So the storage was starting to get bid. So clearly you needed the curve to steepen into contango that way to pay for it. But the real issue was the cost of financing. Like you simply couldn't borrow to buy barrels from anybody because everybody had pulled lines from everybody else and LIBOR had blown out and the banks weren't even lending to each other and the Fed was trying to grease the wheels of finance again and save the world. But that's what it took. Dude, the curve has been backward dated all year despite the smash in the flat price. Like there is no sign from the physical side that we need to store barrels here. The market is screaming for barrels. Well, maybe screaming is a strong word. Anywhere from calling out quietly in a whisper to yelling for barrels, depending on the day. And so, like, yeah, it's okay. I sound like a guy who's on the wrong side of the trade. Actually, I bought calls in July when vol was in the basement, and vol has more than doubled for crude in the fronts, thanks to everything going on in the world. So actually, for like some of these calls, I'm knocking on flat. Like there are ways to structure a bull view without getting wrecked in it. I've lost a lot more money, say, in the grains this year than I have in energy. But like I get a lot of crap for being long oil because I don't know, like maybe it's just rubbing people the wrong way on the call. But I tend to think that it's not going to take much from a volume perspective to chew through what people perceive as spare. And what really bugs me on the supply side is that if you just spend time looking through the data and the numbers, the U.S. shale patch is very clearly flattened out. And the greatest thing about what's going on in oil now is that it's happening at a time of year when the strip has come up a bit, oddly enough. So like now the long end is kind of in the low 70s versus upper 60s, which is really interesting to me because I'm trying to figure out why the curve is inflating over the last like 2 weeks. The simplistic explanation is, geopolitics, bro. Like, no, that's not how this stuff works. Like, you don't inflate the whole curve on this. Like, there's something else going on here. I tend to think that it's actually nobody's hedging anymore. Not that hedging really happens after a year out anyway, but like if you borrow from a bank, they usually make you put on a hedge somewhere if you're a producer. And I tend to think that like guys are like the borrowing in the sector is actually shrinking to a point where there's a lot less hedging going on. And of course, specs are net short. So that means commercials are net long. So even producers as a group are not really hedging anymore. But all of this is happening in October in the context of budgets being drawn up for 25. And even with the strip kind of bumping up from low, upper 60s to low 70s in Brent, you're kind of sitting here thinking like, this isn't predictive for the price next year, but guys look at the strip to budget, and nobody's going to spend more money looking at the strip where it is, you know what I mean? And with the flat price where it is. So I think we're running into an accident next year where if consumption really starts to move, driven by emerging Asia, LATAM, et cetera, and I'm right about U.S. disappointing, like the consensus in the market, just so you're aware, for the U.S. production, like we're in the kind of low 13s, right? Million barrels a day. The view is that over the next 2 years, this grows by 1 to 1.5 million barrels after 2 years, that we will go to like mid 14, upper 14. Okay. Mm-hmm. I'm struck by this number because the bulls will sit here and say, we might not get 500,000 barrels plus a day incremental next year. It might be 250,000. And I'm like, we'll be lucky to be flat. It could be down. And if it's down and we're like a 12 handle this time in like next year, year over year, the oil market is going to be a shit show because the only thing that you have left then is OPEC spare. And if you saw the EIA numbers that came out yesterday, like we're running 1.5 million barrels for the month of September of consumption over production. I think it was like 103.5 for consumption, and the production was like 101.5 or 102. I have to double check my notes, but we're in deficit now. Now we're supposed to be, but like the refineries are also going into maintenance and turnaround. So I don't know, man. I like the setup. I really think that the only thing that bothers me about oil, to be honest with you, is not that it's invisible, it's that it's contentious. I really don't like contentious trades like, short or long Tesla, shit like that. Like it bothers me that oil is a contentious thing where there are a lot of guys with their heels dug in on both sides. That's generally not a healthy market. I'd rather be in stuff that's invisible where guys just don't care. A lot of people seem to care about the oil market. And so I think it's going to be kind of crazy to trade for the next sort of few months. I would much prefer if oil had been kind of invisible and nobody gave a shit. But excuse my language. But that's the only thing really that bothers me, because otherwise the setup is there. Sorry, that was.
Yeah, no, that's fine. But I was thinking, I just started reading Peter Atwater's latest book, The Confidence Map, and I don't know if you've read it, Paulo, but it's an incredible book of visualizing where you're at between control and basically how to visualize where we are with the confidence as a country. And right now it seems like we're pretty stressed out. We're stressed out as a society. We're stressed out with inflation. We're stressed out in trades and markets. Like it's pretty fascinating. That's what's visualizing in the back of my head as you were talking right there. I think we've solved all the world's problems, or at least we've expressed what the problems are. And we're going to leave it at that. My friend, I can't, you've given us so much to think about, as you always do. And I can't thank you enough for the hour you've given us. And I want to appreciate, everything. I do appreciate everything you do. I can't recommend your Substack enough. We're at PauloMacro .substack.com. And I know you're on Twitter. You've created such an incredible Twitter audience as well. So maybe remind us where that is as well, if people are not following you.
Yeah, no, I'm the Cloud Bear avatar, Paulo Macro, Paulo Macro on Twitter, and then paulomacro.substack.com. Always a pleasure to catch up with you, Trevor, and I appreciate the plug. For me, writing is part of the process. I like the sort of meeting new people. It's been more effective to do on Substack than Twitter, because there's a lot of noise and a lot of lurkers who don't really kind of sort of engage with you in real life. But I've been very fortunate to be able to kind of replicate in the more kind of enclosed and open environment, open in the sense of like just people willing to stick their head up and exchange ideas on Substack as well. And for me, it's a healthy part of the process of thinking out loud and trying to solve the unsolvable puzzle that is the financial markets. But very grateful, and honestly, I'm shocked that I have the following that I do. I really, if you had told me 4 years ago when I started writing on Twitter that I'd have this follower base, I would have laughed. Like, who wants to follow some anonymous guy talking about finance? But it's been great.
People appreciate good work and big thinking, right?
No, I'm grateful for it. It's been great, Trevor. Happy to come back, and thanks for the chat, man.
For sure. All right, everybody. We'll be back. We're gonna take a short break, and actually, we got one more segment for you in this long form, so do stay tuned. Paulo, thanks so much. Have a great rest of your day.
You too.
All right, everybody, welcome back into our second segment of this week's long form episode, and we're going to turn our attention to Mexico. And who better to talk about the mining sector in Mexico other than our friend Doug Ramshaw, president of Minera Alamos. Doug, the last time you and I chatted was at the Beaver Creek Precious Metals Summit, and you were generally kind of open about the concerns out of the investment community regarding a potential open pit mining ban, given the presidential transition from AMLO to Claudia Sheinbaum. We've got news in the last couple weeks that that proposal is not in the books. She released kind of a 100-point, directive of where she'd like to take her administrations and things she would like to accomplish in the country. And really, mining was not really part of any significance in that. And so the investment community took that as great news, thinking that open pit mining is still relevant and positive for the country. And we saw a lot of, I don't want to say re-rating, but at least people were starting to hit the bid back again with Mexican equities in the development sector for mining. So, including Minera Alamos, I might add. So, watching this whole thing play out, I mean, let's get your takeaways here. And, you were pounding the table that the concerns were maybe overdone. This was last month, and obviously we get a little bit more light that, yes, things were overdone.
Yeah, they certainly were, and I think there was maybe a worthy overreaction to a non-news event last Friday in that, we haven't seen anything positive in Mexican headlines for 2+ years. So kind of understand a bit of a relief rally, but all this thing about 0.87 no longer exists, open pit mining ban is not going to happen. It's like her 0.87 in her electoral platform did not talk about an open pit ban. Like that was the insanity of the situation. It was never tabled as such. Only thing that got tabled more aggressively than her own election platform was a bill that came out of committee stages to the lower house that everyone was fearful would get approved in the lower house in September. Um, and then have to fall to the Senate, where it was likely going to be dead on arrival. And that committee bill was more aggressive than, and it still sits there to be discussed and potentially amended and legislated before it goes to the Senate. But it was stronger language than Claudia Sheinbaum. So, her not talking about open pit mining bans last week was no different than her not talking about open pit mining bans in her electoral platform. So, it was kind of weird. But I guess we did survive September, where really the only thing passed, because I think AMLO in his last few days in office, from weeks in office, wanted to score wins. He got his judicial reform passed. And whilst, yes, that's great, mining didn't come up, like, we shouldn't hide the fact that those judicial reforms were not good. Um, you know, uh, and I think, Ms. Scheinbaum, who's really been echoing, very support toward in her inauguration speech, support to foreign investment and everything else. So, that judicial reform's probably not helpful to her in that regard. But if she wants to show Mexico's open for business, I think, her support for the mining industry is an important part of that. And she has countless times on the election campaign advocated for mining in Mexico. But she's also done it with the caveat that mines should have strong community local support, as they should anywhere in the world, and should pass a strict environmental review, as they should anywhere in the world. There's nothing that's too crazy about that. So yeah, the Colorado conferences were a good opportunity to kind of push back a little against a narrative out there, such a, which we're a narrative which is much more nuanced. So we talked about it in Colorado. Beginning of September, there was an article, because of that bill that came out of committee stages. And we know, like, you look at your country, the US, there's a lot of, let's call it batshit crazy stuff that gets to the floor of the House of Representatives that CNN and Fox will say is dead on arrival in the Senate. But it doesn't mean it doesn't get advanced to a certain stage before it dies and withers on the vine. The reality is, we've dealt for 2 years with headlines such as the Reuters one that, splashed the headline, open pit mining ban advances in Congress, when that bill came out of committee stages. I think that would have been a reasonable headline if the committee bill, unamended, passed a vote in the lower house and went to the Senate. But it seemed an overreach, of the reality of the situation. But that's what, in many ways, that encapsulates the last 2 years in Mexico. Headlines have suggested the sky is falling, that mining is no longer relevant in Mexico, that one should be fearful of any future, the prospects of any company looking to bring a new mine into production there. That's what we've dealt with for 2 years. So kind of relief rally last week? Yeah, absolutely. Are we fully out of the woods? No, I don't think. He invested in open pits in
That's right.
Mexico.
That's right. I heard he was.
Um,
I heard he was shorting it.
yeah, no, it's like he's just read the Reuters article and reacting to it. That's what that is right now. It's like, what the hell? No open pits. No, so so I think in many ways last week, even though I thought, uh, why are these stocks reacting to what was a no news thing? In many ways, I think the reaction was a sense of relief, um, that more stuff wasn't advanced in September, that it has been pushed off to Miss Scheinbaum, who is making a lot of very pragmatic, you know, uh, moves here and saying the right things to court foreign investment, talking about the importance of the relationship with the U.S. and Canada, where, let's face it, her predecessor had bumped heads routinely in that regard. Even recently on the passing of the judicial reform, and some of the comments that came out of Canada and the U.S., there was all the bluster that we are used to from AMLO. So, now I think as a market, as a basket of companies in Mexico, we're going to be waiting and seeing, does this move, see us move forward on permits?
Yeah.
That's the next shoe to drop, right?
Yeah, let me bust in here, Doug, because
Yeah.
I do want to kind of head the conversation into that direction. But before we get too far, I want to ask you about these judicial reforms that were put in place before Emma left. How does that affect mining sector in Mexico, and why is that kind of keeping the mining sector from having full wind to its sails?
Well, I just think it's more of a dark cloud on Mexico than necessarily mining in Mexico. Like
Okay.
it was it, it was portrayed as helping to stamp out corruption that was perceived by AMLO in the court. So the courts have not always sided with him. In reality, I think it was more about concentrating additional power. There should be separation between the politics and the legal system. And unfortunately, I think it's become more entwined now, and that's never a good thing. Um, I looked, honestly, when I looked at it, it was like all judges, including Supreme, there were about 20, 25 different points on this. I stopped reading after a couple of points that jumped out at me. And I mean, I think any listener would listen to this and think, well, yeah, I'm not sure how that stamps out corruption or maybe embraces corruption, because the new reforms dictate that every judge, even Supreme Court justices, are elected by popular vote. And judges no longer even need to have experience. I stopped reading after that point. I mean, there was a certain absurdity to it. And, the reality is that's just not a good system of law. It's too, obviously the political party down there is very popular. It's a populist party. It does a lot of popular things. Now suddenly, your judicial system is going to be purely by popular vote. That's what's going to happen there. There's further concentration of power, and so it's not helpful to Mexico, in my opinion. Not so much, how it affects mining. I think it has less of an impact on mining, but more of an impact on how people are going to perceive Mexico just generally, rather than being mining specific.
All right, so let's talk about how things are kind of looking, other than this the proposed ban on open pit mining. That appears to be off the table, but there are other kind of challenges that the sector was faced, before this transition. Freezing of concession grants, very slow permit approvals, which I know you have your amendment is something you've been stuck with. Is there any sort of evidence that under this Sheinbaum presidency, those challenges are going to be alleviated?
I I think the evidence, yes, I think we'd already heard. No, I mean, what was useful for me in Colorado was not just to be able to talk to people about it being much more nuanced than the headlines. It was about talking to our larger peers down there that are hearing the same things. It's not that I kid I, obviously we need permit progress. But hearing what we're hearing from other bigger companies gives you comfort that you're not taking this with this rose-colored glasses approach to, well, we need permits, so don't worry, everything's fine. I don't want to be that dog in the house is burning meme. But so hearing that from other bigger parties at Sermonat, the environmental permitting body down there. I mean, we'd heard that, there was a lot of stuff has just been held up at Sermonat purely because Sermonat, like a lot of other departments, got gutted at the beginning of AMLO's, he culled the civil service. That's actually resulted in a lot of delays. So regardless of mining, when you are trying to show Mexico as a great place for nearshoring and foreign investment, you need your authorities to be working in a timely manner. Mexico is always remarkably quick on permitting relative to Canada and US or the like. Will it ever get back to that being that quick again? I'm not sure, but can it still be quicker than Canada and the US? Absolutely. And so I think you have to start looking at, it's been hard, right? Like in this environment, it's been very hard to give any kind of accuracy to timelines. Investors demand timelines, but then don't like it when you slip because you're giving best guesstimates at a time of incredible fluidity in how things actually are operating down there. I think what is encouraging is seeing some companies. Alamos Gold is a good example. About a month ago, they announced a part of their Mulatos complex in Sonora. They have this PDA deposit, which is an underground deposit there. It requires an amendment to their permit. Now it's underground, but that aside, that permit amendment is the kind of thing that has just got bogged down in almost this de facto or shadow stalling of everything. They've indicated they expect that by year end. And whilst it's underground, I think, that might be one of the first even permit amendments in, basically through this election year to come through. That's a positive statement to see it. I believe Tony McCooch, I saw it reported, I think, in the Mining Journal. I didn't listen to his presentation in Denver. But I believe at Discovery Silver, who are permitting a greenfields open pit giant thing in Chihuahua. He indicated that they're looking for their permit early in 2025. I think that's going to be huge because it's a greenfields project. I mean, the low-hanging fruit really are things like permit amendments, but to see a greenfields project there is going to silence even the most diehard naysayer on the Mexican permitting side. And we are not far away from early 2025. So I think there are going to be tangible moves by companies, and including us, that will shine a light on this neglected area in terms of this bull market. There's been no reason to buy Mexico, maybe up until last Friday, where there was this glimmer of things improving, although actually anyone that really understood the situation could see things were improving even before that. And and that's why Discovery Silver and Minera did actually advocate strongly. Clearly they did as well in Beaver Creek, and people started listening beyond reading the headlines.
Yeah, absolutely. It's been nice returns if you were able to kind of pick up shares at those recent lows for you and the other rest of your peers there in Mexico. Doug, before we let you go, quick update with kind of end of Q3. When will numbers and kind of updates from Santana be published into the market? What can you share with not only your shareholders but other listeners here on the pod?
Yeah, I mean, Q3 was mining and stacking was going to increase. So I think we've already guided that Q3. We gave a pretty good range in that guidance, which we'll stick to. You know, whilst it's the start of ramp up in Q3, we mined and stacked more than the whole of 2023. Whilst the number seems modest as you're opening up the pit and ramping things up, it was a step change in operations there at Santana. Q4 we'll start seeing that production, the benefits of that mining and stacking and increased leaching flow through into better production numbers. And I'm wary on this, but there's two elements to our permit amendment or like the pad expansion at Santana. Part of it definitely needs the permit amendment. It's got to be approved at the federal level. There's certain stuff with regard to the pad and the site in general that can actually be done at the state level. And we're already seeing certain progress on parts of the full-fledged permit amendment that we've stripped out to do at the state level, and we're seeing some progress there. So I think we'll be able to project some improvements in terms of pad capacity and the like that can be built out in Q4 and into Q1, regardless of when that permit amendment comes through, which will also be positive in terms of additional runway beyond this current mine plan that we have in place for this next 12-month cycle from June last year through to the summer of next year. So that's all good. And certainly I think the most encouraging thing is what we're hearing on the ground, which I think bodes very well for Cerro de Oro, which obviously is really the future value driver of Minera. And so I think 2023 was a bit of a write-off year. 2024 was about a year of transition, kind of similar to the government down there. It's funny how those have coalesced. But a year of transition, and 2025 is where that transition really hopefully shows exactly where the company can be headed. So I'm very optimistic about how we close out this year and the year ahead.
All right, Doug, have yourself a wonderful Canadian Thanksgiving on Monday. Enjoy the long weekend. And thanks for the update. I think there's a lot more clarity on what's happening in Mexico now in the last couple of weeks. And kudos to everybody who was out there in Colorado kind of pounding the table and, taming some of those fears. But thanks so much, Doug. We will touch base with you again here the next couple of weeks.
Sounds good.
All right, everybody, that's a wrap on the long form this weekend into a long weekend. And again, happy Thanksgiving to all of our friends up in Canada, and be safe. Enjoy your time. We'll talk to you again Monday morning with the morning briefing. Be well.